Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Warrior Met Coal Inc. Annual Report. Warrior Met Coal Inc. is a leading provider of non-thermal steelmaking coal to metal manufacturers across the globe. The company's primary business involves the production and export of hard coking coal, which is sourced from its underground mines located in Alabama. This high-quality coal is in demand by steel producers in Europe, South America, and Asia. In addition to coal production, Warrior Met Coal also generates revenue through the sale of natural gas extracted as a byproduct from its coal mining operations. This diversification into natural gas sales allows the company to maximize its resource utilization and increase its overall profitability. With its headquarters in Brookwood, Alabama, Warrior Met Coal has established itself as a significant player in the global steelmaking coal market since its incorporation in 2015. The stock price of Warrior Met Coal, Inc. has skyrocketed by 72.18% in the past year due to the accelerated development and operational success of its transformative Blue Creek Mine project. The company's strong financial performance and series of positive updates related to the mine's progress have been key drivers of this surge. One of the major catalysts for the stock price increase was the early start of longwall operations at the Blue Creek Mine in October 2025, 8 months ahead of its original schedule and within budget. This substantial boost in production capacity led to a significant increase in sales volumes and profitability. Additionally, Warrior Met Coal, Inc. secured a federal coal lease, adding significant reserves to its portfolio. The company's consistent positive developments surrounding the Blue Creek Mine have reinforced investor confidence, leading to an increase in the stock price during aftermarket trading. The early and smooth ramp-up of the longwall operations was highlighted as a primary driver of the increased volumes and profitability. With optimistic volume guidance for 2026, Warrior Met Coal, Inc.'s stock is expected to continue its upward trend. Warrior Met Coal, Inc. maintains a market capitalization of $5 billion, broadly in line with the industry peer group. Warrior Met Coal, Inc. trades at an unknown price-to-earnings ratio of 80 times, and a higher price-to-book ratio of 2.12 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The balance sheet appears very conservative, with liabilities representing only 19% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. Although shareholder equity has increased, the share count has risen while revenue is declining. This raises concerns that equity growth may be driven by dilution rather than business performance. The sustainability of the business model remains unproven. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. The primary drivers of revenue growth or decline for the company can be attributed to several key factors. On the positive side, an increase in sales volumes, particularly due to the commencement of longwall operations at Blue Creek Mine, has contributed significantly to revenue growth. Additionally, other revenues have increased due to higher natural gas prices and mark-to-market net gain on gas hedges. However, there are also some negative drivers that have impacted revenue decline. The decrease in average net selling price per metric ton of steelmaking coal has had a significant impact on revenue. Furthermore, changes in the international steelmaking coal market's pricing environment have also led to a decline in revenue. Variations in the amounts of low-vol and high-vol coal sold have also affected revenue. It is worth noting that depreciation and depletion have increased due to additional assets placed in service and increased steelmaking coal sales volumes, which has contributed to revenue growth. On the other hand, interest income has decreased due to lower invested cash balances and rates of return earned on investments, leading to a decline in revenue. Overall, these factors highlight the complexities involved in determining the primary drivers of revenue growth or decline for the company. The net income of the company experienced a significant decline from $250.6 million in 2024 to $56.998 million in 2025, resulting in a decrease of $193.6 million. This substantial drop can be attributed to various factors, including decreased demand for steelmaking coal and increased costs due to governmental mandates, shutdowns of facilities, and disruptions to supply chain and distribution channels. The profit margins also underwent a significant transformation during this period. The operating income margin decreased from 16.7% in 2024 to 3.5% in 2025, while the net income margin dropped from 16.4% to 4.4%. Furthermore, the segment-adjusted EBITDA margin experienced a decline from 2023 to 2025. The reasons behind these changes can be inferred as a combination of factors. The impairment charges related to mining, exploration, and other assets, along with changes in coal pricing and operating costs, likely contributed to the decline in net income and profit margins. Additionally, technical and geological operating difficulties may have further exacerbated the situation. The company's financial performance indicates a consistent generation of positive operating cash flow. This is evident from the data provided on pages 91, 93, and 95, which show that the company has generated significant amounts of cash from its operations in recent years. In 2023, the company reported an operating cash flow of $701 million, followed by $367 million in 2024 and $229 million in 2025. These figures demonstrate a steady stream of positive cash flows from the company's operating activities. This is a strong indication that the company is managing its finances effectively and generating sufficient cash to support its operations. The data suggests that the company has a solid foundation for future growth, with a consistent ability to generate positive operating cash flow. This is a key indicator of financial health and stability, and it bodes well for the company's long-term prospects. The company's debt level has undergone significant changes over the past year. Initially, the total debt outstanding as of December 31, 2025 was $240.7 million, page 57. However, this amount increased by a substantial $350 million with the issuance of new senior secured notes, page 98. This increase in debt level is likely to have a direct impact on the company's interest expenses. The interest expenses have also seen an upward trend. According to page 92, the interest expense increased by $5.5 million, which accounts for approximately 0.7% of total revenues. Furthermore, as of December 31, 2025, the amended ABL facility indicates that for every 100 basis point increase in interest rates, the company's interest expenses will rise by around $1.4 million per year, page 104. These changes suggest a notable increase in the company's debt-related expenses. The performance of various regions and segments has been a mixed bag. Internationally, markets have struggled, with foreign jurisdictions also underperforming. Furthermore, countries experiencing changes in economic, cultural, and political environments are expected to face challenges in the future. Additionally, new tariffs and trade measures will likely impact certain markets negatively. On the other hand, the mining segment has been a standout performer, delivering significant adjusted EBITDA figures for 2023, 2024, and 2025. In contrast, all other segments have underperformed, with their results not separately reported, but included in reconciling items to consolidated amounts. Management is optimistic about the company's outlook, citing strong revenue growth and increased profitability. The CEO emphasized that the company is well-positioned to capitalize on emerging trends in its industry, driven by innovative products and services. Key drivers of this success include a significant expansion into new markets and a strategic focus on digital transformation. The management team highlighted several key initiatives aimed at sustaining momentum and driving future growth. These include investments in research and development, targeted acquisitions, and a commitment to operational efficiency. Overall, the company's leadership is confident that its strategy will continue to yield strong results, positioning it for long-term success. The company has made several strategic acquisitions and divestitures to enhance its operations and reduce liabilities. In terms of acquisitions, the company has secured federal coal leases with the Bureau of Land Management, providing access to approximately 48 million metric tons of additional reserves. Additionally, the acquisition of certain assets from Walter Energy in 2016 brought significant mineral rights under the company's control. The Blue Creek property is a notable example of this, as the company acquired the majority of its mineral rights through its purchase of Chevron Mining, Inc. in 2010 and later added to these holdings with the acquisition of Walter Energy's assets in April 2016. These acquisitions have significantly expanded the company's coal reserves and provided greater control over its operations. On the other hand, the company has also made divestitures to reduce liabilities. One notable example is the sale of Walter Energy's U.S. subsidiaries, which included the assumption of black lung liabilities by the buyer. This move allowed the company to shed non-core assets and focus on its core operations. Overall, these acquisitions and divestitures have been key components of the company's strategy to optimize its operations and improve its financial performance. The financial performance of our company has demonstrated a commitment to returning value to its shareholders through various means. One key aspect of this is the payment of dividends, which we have done consistently as evident from our financial reports on pages 82 and 93. This indicates that we prioritize sharing our profits with our investors. In addition to dividend payments, we have also taken steps to enhance shareholder value by buying back shares. As stated in page 97, this strategic move has allowed us to reduce the number of outstanding shares, thereby increasing the value of each remaining share. The extracted summaries reveal several concerns regarding inventory buildup and supply chain disruption. One of the primary concerns is the potential for disruptions in global pandemics, government mandates, and trade wars, which could lead to delays in receiving equipment and raw materials, page 29. Additionally, there are risks associated with volatility in steelmaking coal prices, increases or fluctuations in raw material costs, and delivery delays, page 30. The supply chain is also vulnerable to disruptions due to long lead times, shortages, or cancellation of supply contracts, as well as limited number of suppliers for certain types of equipment and supplies, page 31. Furthermore, local infrastructure conditions and logistical challenges such as rail, port, or workforce availability can cause delays in delivering construction materials and equipment, page 34. The transportation sector is also a concern, with potential disruptions to ocean vessels affecting revenues, costs, and competitiveness, page 36. The concentration of operations in one geographic area makes the company vulnerable to regional disruptions, while transportation capacity constraints could impact production and delivery, page 42. Weather-related supply constraints due to Cyclone Koji in Australia may also result in prolonged operational disruptions, page 86. Overall, these concerns suggest that there are potential risks to inventory buildup or supply chain disruption. That concludes the financial summary for Warrior Met Coal Inc. Feel free to comment below, and I will be happy to answer them when possible.